Hey there, Mad Money viewers. Welcome back to another exciting episode where we break down the latest in the financial world. Today, we're diving into the world of big data and even bigger profits with Palantir Technologies. This company has been at the forefront of data analytics, making headlines and capturing the attention of investors worldwide. This software company has been making waves, but is it the real deal? With its innovative approach to data, Palantir has positioned itself as a key player in the tech industry. But what does this mean for you, the investor? We're talking about a company that helps governments and businesses sift through mountains of information. From national security to corporate strategy, Palantir's software is used to uncover insights that drive critical decisions. They're like the detectives of the data world, finding clues and solving mysteries. Imagine having the power to turn raw data into actionable intelligence. That's what Palantir offers. Palantir's stock has been on a roller coaster ride lately, and investors are wondering if it's time to buy, sell, or hold on tight. The volatility can be nerve-wracking, but it also presents opportunities for those who know how to navigate it. That's where the Rule of 40 comes in handy. This rule is a key metric used to evaluate the health and potential of software companies, combining growth and profitability into a single, easy-to-understand number. It's a simple but powerful tool to help us figure out if Palantir is worth our hard-earned money. By looking at both revenue growth and profit margins, we can get a clearer picture of the company's performance. So buckle up, because we're about to break it all down. We'll dive into the numbers, analyze the trends, and give you the insights you need to make informed decisions. Now, some of you might be thinking, Jim, this sounds complicated. And I get it. Financial metrics and stock analysis can seem overwhelming. Don't worry, I got you covered. We're going to walk through this step by step, breaking down each component so it's easy to understand. We're going to keep it simple, clear, and straight to the point. No jargon, no fluff. Just the essential information you need to know. By the time we're done, you'll be talking Palantir like a pro. You'll understand the key metrics, the market trends, and the strategic moves that could impact your investment. So stay tuned, and let's get started on this deep dive into Palantir Technologies. Alright, let's talk about this Rule of 40. Think of it as a secret code for evaluating software companies, especially those in the SaaS game. That's software as a service for you newbies. SaaS companies are unique because they often prioritize rapid growth and customer acquisition over immediate profitability. This makes traditional financial metrics less effective in evaluating their performance. Here's the deal. You add a company's revenue growth rate to its profit margin. This combination gives you a quick snapshot of how well the company is balancing its growth and profitability. If the number is 40 or higher, it's a good sign. It means the company is likely managing its resources well and is on a sustainable growth path. Why 40? Well, it's like the sweet spot. This threshold is considered optimal because it indicates that the company is not sacrificing profitability for growth or vice versa. It shows the company is doing a great job balancing growth and profitability. This balance is crucial for long-term success, especially in the competitive tech industry. They're not just growing like crazy and losing money hand over fist. Rapid growth without profitability can lead to financial instability and potential failure. They're also keeping an eye on the bottom line. This means they are ensuring that their expenses are in check and that they are generating enough profit to sustain their operations. Now, the Rule of 40 isn't a guarantee of success, but it's a darn good indicator. It helps investors and analysts quickly assess the financial health of a company. It's like checking a company's pulse to see if it's healthy. Just like a doctor uses vital signs to assess a patient's health, investors use the Rule of 40 to gauge a company's financial well-being. And trust me, in the fast-paced world of tech, you want to invest in companies with strong vital signs. Companies that meet or exceed the Rule of 40 are often better positioned to weather economic downturns and capitalize on growth opportunities. So, next time you're evaluating a SaaS company, remember the Rule of 40. It's a simple yet powerful tool to help you make informed investment decisions. Happy investing! So, how does Palantir stack up against the Rule of 40? This is a crucial metric for evaluating the health and potential of a tech company. It combines revenue growth and profit margins to give a comprehensive picture. Well, it's a bit of a mixed bag. On one hand, Palantir has shown some strong performance metrics, but on the other hand, there are areas where they fall short. Palantir's revenue growth has been impressive, no doubt about it. they've managed to secure a steady stream of income, which is a positive sign for any company. They've been signing deals left and right, especially with government agencies. These contracts are often long-term and can provide a stable revenue base. But here's the catch: their profit margin hasn't quite kept pace. Despite the impressive revenue growth, their profitability is lagging. They're still spending a lot of money on research and development, as well as sales and marketing. These are essential investments for future growth, but they do eat into current profits. That's not necessarily a bad thing, especially for a company that's still in growth mode. Investing in innovation and market expansion can pay off in the long run. However, it does mean that Palantir's Rule of 40 score isn't quite where it needs to be. The Rule of 40 suggests that a combined score of 40% or higher is ideal, and Palantir is hovering below that mark. They're not failing, but they're not acing the test either. It's like getting a C+ on a report card. It's passing, but there's room for improvement. They're somewhere in the middle, which can be frustrating for investors who like clear-cut answers. Investors are often looking for companies that either clearly excel or clearly need improvement, and Palantir's mixed performance can be a tough pill to swallow. So while Palantir has a lot of potential and some strong points, they also have areas that need work. It's a company in transition, and only time will tell if they can balance their growth with profitability. For now, investors will have to keep a close eye on their progress and hope that the investments in R&D and marketing will eventually pay off. The journey of balancing growth and profitability is a challenging one, but it's not impossible. In the end, it's all about perseverance and strategic planning. Palantir has the tools and the talent. Now, it's about executing the right strategy to achieve that coveted Rule of 40 score. Okay, so we know Palantir's revenue is growing, but what's driving that growth? Well, for starters, they've got some seriously powerful software. I'm talking about the kind of technology that can analyze massive amounts of data and find connections that would make Sherlock Holmes jealous. And who's using this amazing software? Everyone from intelligence agencies to healthcare providers to financial institutions. Palantir's client list is like a who's who of powerful organizations. But it's not just the software. Palantir also has a knack for attracting top talent. We're talking about brilliant engineers and data scientists who are passionate about what they do. And that passion translates into innovative products and happy customers. Section 5, Storm clouds on the horizon, potential risks to consider. Now before you go all in on Palantir, we gotta talk about the risks. Because let's face it, every investment has its downsides. One of the biggest concerns with Palantir is their reliance on government contracts. Government spending can be unpredictable, to say the least. What happens if the budget gets tight and those contracts dry up? That could put a serious dent in Palantir's revenue. Another risk is competition. Palantir might be a big fish in the data analytics pond, but there are other sharks circling. Companies like Microsoft and Amazon are also investing heavily in this space, and they've got deep pockets. Section 6, the balancing act, growth versus profitability. Now let's circle back to the Rule of 40. Palantir's still figuring out that balance between growth and profitability. They're investing heavily in research and development, which is great for the long term, but it also eats into their profits in the short term. It's a tough balancing act. Grow too fast, and you risk burning through cash. Focus too much on profits, and you might miss out on valuable growth opportunities. The key for Palantir is to find that sweet spot. They need to keep growing at a healthy pace while also showing investors that they can turn a profit. If they can do that, their stock price will take care of itself. Section 7, crystal ball gazing. What does the future hold for Palantir? So, what's the verdict on Palantir? Well, it's complicated. They're a fascinating company with incredible technology and a bright future, but they're also facing some real challenges. The next few years will be crucial for Palantir. They need to prove to investors that they can maintain their growth while also improving their profitability. If they can pull it off, they have the potential to be a true tech titan. But if they stumble, their stock could be in for a bumpy ride. Investing in Palantir is not for the faint of heart. It's a high-risk, high-reward kind of play. Section 8, to buy or to bail, a word of caution for investors. Now I know you're probably wondering, Jim, should I buy Palantir stock? And the honest answer is, it depends. Are you a risk taker who believes in Palantir's long-term potential? Then maybe it's worth a shot. But if you're looking for a safe and steady investment, Palantir might not be the right fit. Their stock is volatile, and there's no guarantee that they'll be able to overcome the challenges they face. Remember, investing is like playing poker. You need to know when to hold them and when to fold them. And with Palantir, it's still too early to tell if they're holding a winning hand. Section 9. Final thoughts, Palantir's future in the tech landscape. So, there you have it, folks. Palantir's a company with a lot of potential, but also some significant risks. The Rule of 40 tells us they're not quite firing on all cylinders yet, but they're working on it. Keep a close eye on their progress, especially their profit margins. If they can start moving those numbers in the right direction, Palantir could be a real winner. But until then, remember to invest carefully and never bet more than you can afford to lose. Stay tuned, because the world of tech is always